I've never waited tables, but I have a lot of friends who do, and a lot of friends who cater.
What percentage of tip income is reported?
Right. Like, and
Very low.
and what is the impetus to report it, right? So for most people, you're making the average American salary or less, and you have tip income. Why the hell would I report it? What's going on, everybody? My name is Hassiem Muhammad, and you are listening to The Actor's Instrument, Tools for the Long Game. Before we dive in, you know the drill. Please make sure to like this episode, subscribe to the channel, or give us a follow if you're streaming. It helps us out a ton, and our subscribers have been climbing this past month on YouTube. So thanks to all of our new subscribers. Welcome. We'll hope more of you will join us soon. If you tuned in last week, you know that there are a myriad of considerations for artists when it comes to financial planning. So much so that we have last week's guest returning for a part 2 this week. Dr. Elaine Grogan Luttrull is a certified public accountant and accredited financial counselor. Her workshops and presentations have been featured nationally by groups that support the arts, a variety of state and regional arts councils and commissions, and colleges and universities where creative students thrive. She is the founder of Minerva Financial Arts, a company devoted to building financial literacy and empowerment in creative individuals through education and coaching. Elaine spent 10 years in academia, teaching at the Columbus College of Art and Design and serving as the department head for business and entrepreneurship from 2014 to 2018. Before that, she served as the director of financial analysis for the Juilliard School and in the transaction advisory services practice of Ernst & Young in New York. Elaine, welcome back.
Thank you so much. What a pleasure it is to be here for part 2.
I'm so excited. Literally, Elaine and I were emailing after the last recording because I was like, there's so many questions I didn't get to.
There's so much more.
There's so much more. And she is incredibly, incredibly generous. And she was like, I would love to come back on. Let's give the people more. So here we are.
So wonderful to be here. Yes. Exciting stuff we've got queued up too. So I can't wait to get into it.
But to start, let's break the ice. Let's play a game, a little red light, green light, financial advisor edition. Okay. I have a few prompts. When I make the statement, you'll respond with a green light if you're like, yeah, that's good. No problem with that. Yellow light if it's fine. Maybe I wouldn't recommend it, but like fine, it's legal and won't ruin you. Red is like, absolutely not. Call the IRS right now. Red light, yellow light, or green light. Living entirely off of my biggest month of income.
Oh, red light. I'm sorry. We don't have to call the IRS on that, but like, that's so risky. That's so risky. Unless that biggest month, right, is contractually bound for the extent or a very long period of time, right? Which, I mean, they never are, right? That is so risky in the arts. Things are just too unpredictable and finicky. So yeah, I would definitely red light that one.
Upgrading my apartment after a really great booking.
No. I mean, I get it. Right. I get it. There's a human reaction and I totally get it. Right. And my goodness, would I rather you pocket some of that extra good booking money to give yourself a better cushion? Just because, it's likely that a good booking will lead to another, but it's not guaranteed. And I would so much rather you use that good booking to give yourself some more breathing room, save a little bit more for retirement, do any of those things that we can't always do in the not so great booking years. So yeah, I would definitely solid yellow light is approaching red on that one. Right. You're pushing the intersection. Don't do that.
Heard. Okay. What about this? Not taking out a disability policy because I'm healthy. I don't need disability insurance. My knees work fine.
I mean, green, noting that it's a stale green light, maybe, right? It might turn yellow at some point, mostly because I don't think it's required that you take out a disability insurance policy. I think anytime we're thinking about risk and reward, right, or managing risk, we want to understand what the risk is. And then we want to mitigate the risk by doing squats and lunges and keeping your knees healthy or whatever the equivalent is, right? So we want to do everything within our power to mitigate the risk. And if that still isn't enough, that's when we would look into transferring the risk to someone else through some sort of insurance policy. But I think there are plenty of people who might land on, you know what, the cost of this insurance policy doesn't line up with the risk I'm mitigating. And so in that case, yeah, totally makes sense. Now, if you're playing pro basketball, right, I might give you a different answer. But I think in that case, all that means is that the risk sort of cost trade-off analysis would land differently, right? So green, but make sure you're doing that on purpose instead of because you've just never heard of disability insurance policies and you didn't know you could do it.
Sure. And for the people at home, I have one. I do. But
what do you have insured? Is it your knees or is it something else?
No, it's basically my insurance policy is like, like the government has like definitions of disability. It's like if one or more of your daily routines is heavily impacted, right? So like, I can't feed myself or I can't bathe or whatever. If I hurt myself to the point where I couldn't perform, I'd get a check every month. That's it in a nutshell. And like Elaine said, it was a calculated expense because it is an expense. Not a bad one, but it gives me peace of mind. And I am financially in a place where it's affordable. But yes. I agree. It's not necessary.
It's definitely not something that every single person needs. And I love that yours is sort of generally and broadly defined disability. I've seen other policies, surgeons might insure their hands specifically, for example, or sometimes we see that among musicians, right? Mm-hmm. And that sort of also protects the idea that like, okay, a surgeon might still be able to teach about surgery, even if she or they can't perform it, right? So the idea of sort of understanding that specific risk and then knowing what your policy really covers and being able to explain it is huge because insurance is like a whole mess of complications.
Sure. All right, here's another one. Putting excess income into a high yield savings account instead of investing.
I think green light if you don't have a ton of savings, right? So if this is like the first dollar or $100 you're saving, right? Yeah, throw it in a high yield savings account. If you are someone who already has an amount you deem to be enough in your high yield savings or in your quickly accessible cash, right, to get you through rough times or an emergency or something, right? At that point, I'd probably say like solid yellow approaching red light, right? Because at that point, you are quote unquote losing out on additional gains. Now, I do work with people who are just like, the market's not for me. It's not worth it. Totally fine. We could throw something in a CD or some bonds. There are like safer options that are not quite as risky as the riskiest options, but that still give you more than a high yield savings account will give you in interest.
And last but not least, not setting aside money for taxes as I go.
Red. That makes me really nervous and uncomfortable. Only because, oh gosh, there are so many just really rough stories about tax debt, right? The IRS is not going to let you get out of paying your taxes, right? Now, there are payment plans and there are other sort of workarounds and solutions we can find, but especially those first couple of years, and especially maybe a year when you have shifted entirely to self-employment instead of W-2 income, your taxes are going to be more than you think they are going to be. So I do recognize that sometimes we need to pay rent and get groceries, right? Sometimes there are cash flow things, but if you can set yourself up to be saving roughly 30% of what you're bringing in for taxes, or more than that if you've undersaved, or less than that if you have oversaved, right? But if you're somewhere in that range, then tax time will not be stressful for that particular reason.
Get an accountant, folks. They will
it's a great investment.
That's a mistake I made early on in my freelance career was I was okay, not completely this example. I was saving for taxes, but I wasn't paying them quarterly.
Okay.
It was
Yeah.
just sitting. I was kind of annoyed at like having to remember to every quarter go in and make a payment. And I was like,
Fair.
oh, I'll just pay at the end of the year. And
Yeah.
that was fine until I made a certain amount of money.
Hmm.
And then, oh, now there's interest and penalties.
Yeah. And I have, again, I work only with creative people, and sometimes creative people make really intentional choices, right, that other folks might not make. And I have worked with people who are like, you know what, I'd rather just pay the penalty. Like, it's not worth it. I would rather just pay the penalty. And that is okay. But good Lord, like, that's free money that you are giving away, right? And you can, especially once you get good at it, right? You can mark your calendar. You probably even now start setting up some auto payments. The IRS has been working on its website and technology. It's not great, but your accountant can also handle this for you too. So yet another reason to maybe bring on a team member that can take some of your stress away.
Yeah. The IRS website looks like it was built in the 80s, but they're coming after you like it's 2027. So
yes,
stay on top of it.
And, call your Congress people and, support them as they increase funding for the IRS's technology, right? Because wouldn't it be nice if the IRS website allowed you to like file your taxes for free, or, had really, really, their support is really wonderful, but there just aren't enough people, and there really just aren't enough technological investments to keep it up to pace. So.
Alrighty, let's dive into some of the questions that we didn't get to last time. We spoke briefly during Red Light, Green Light about some investment things. And I know artists, freelancers, we hear all the time, whether it's on TikTok or YouTube, you need to invest, like your money needs to make you money. But many of us don't have access to employer contributions. We don't have like an employer 401k, or say you're an actor, but you're not in the union and you can't participate in your union's 401k, or say you are in the union, but you make more money outside and doing outside work than within the union. What's your recommendation? How can we begin preparing for the future? Because it's coming, whether we're ready for it or not.
Agreed. And so what's so interesting to me is, this idea of sort of investing in your money, making you money, right? You can do that for retirement. And that is one of my favorite ways of doing that. But sometimes people are also just talking about it through like a brokerage account or these sort of passive investments, right? Nothing is ever totally passive, if I'm being honest, right? But in the context of retirement, again, it is really complicated, and people switch jobs a lot. There's a lot of things going on. Every employer has different options if they have options, right? So step one is just figure out what you have, right? Do you have eligibility for a pension, maybe, depending on sort of your benefits? Do you have eligibility for retirement plans where you have contributed and they're hanging out, right? Or if you are working and have access to any sort of employer-sponsored or union-sponsored something, participate, right? That is like the low-hanging fruit. Really participate if they're matching money that you're putting in, but participate, because at a minimum, the employer or the union or whoever, is covering the fees to administer the plan. So definitely do that if you can. If you can't, and there are definitely years when you might not be able to, your next option is something called an individual retirement account. You can participate in this as long as you or your spouse have earned income, right? So if you have earned income, then you can contribute up to $7,000 into an individual retirement account. It can be traditional or Roth, but that cap is $7,000 until you're age 50 or older. That's sort of your next option. If you can save up to $7,000, throw it in an IRA. If maybe you say, Elaine, I can save more than that, like business is good, then things get really fun, because if you are self-employed, right, you have any sort of self-employment income, you have the opportunity to open a retirement plan through your self-employed business, even if you are a sole proprietor, right? No matter your entity structure, if you are self-employed, you can open a retirement plan as a self-employed person. And the benefit of these plans is that the contribution limits are higher than $7,000. Now, they're also more expensive. So if you're like, Elaine, I can save $3,000, I will high five you and say IRA is your best option right now. But if you have a really good year, you win a bunch of awards, financial awards, like if it's a good year, that's probably a time that I want to think about opening a SEP IRA or a solo 401k. Solo 401k will give you the highest possible contribution limit. You can contribute up to your elective deferral amount, right? Which is $23-ish thousand right now, depending on the year that you're listening to this in, right? Plus 20-ish% of your adjusted net business income. So that'll give you the highest possible contribution. Yeah. However, maybe you have a W-2 job and you are already kind of maxing out that elective deferral, right? And maxing out all those benefits. A different option would be this SEP IRA. For a SEP IRA, you can do a 20% of your net adjusted business income contribution, and it doesn't count against your individual elective deferral. Why? Because it's coming out of the business pocket instead of the human pocket.
Right.
So if you're just looking to squeeze out a little bit of extra retirement contribution and you already have a 401k or 403b through a job, a SEP IRA can be a really great option for that. And in all cases, you want to get it set up with a trustworthy partner so it's compliant with all the rules. You probably want to work with someone on the calculation to make sure that you are sort of not making illegal contributions to it, right? And you're staying under those caps. It will cost you a little bit to administer, but you open the plan, you put the money in, and then you make the investment choice with those dollars. So those would be my suggestions. Max out free money that you have or any sort of existing options, right? Make sure you're clear on what you have, right? What those existing options are. IRA, if you can contribute up to $7,000, SEP or solo 401k if you can do more than that.
Heard. So the SEP and solo 401k, I am not as literate on. What's the difference or what is the additional benefit, if any, compared to a brokerage account? And for those who are unfamiliar with what even a brokerage account is, basically it's just an account where you can make investments willy-nilly.
And they grow.
And then it's just
and
like
they shrink, but they grow generally.
Yeah. Right? It's just like
yeah.
it's like a version of a bank account, but to make investments with. And it's not attached to your retirement specifically, although you can be putting money in there if that's your intention to retire with it.
The two big benefits for SEP and solo 401k versus brokerage account both have to do with taxes. Contributions you make to any retirement plan, not a Roth, but a solo 401k or a SEP or a traditional IRA, count as a tax deduction on your personal income tax return, right? Not on the business schedule. So these contributions will not get you out of Social Security and Medicare taxes, but they will reduce your federal, state, and local income taxes. So that's the first benefit. You get the tax deduction on the contribution. If you put money in a brokerage account, amazing, but no tax deduction on that contribution. You can also take it out anytime, which is not true for the retirement money, right? So there's the trade-off there. The second benefit, also tax related, is within those retirement accounts, you have what we call tax deferred gains. So let's pretend you've got $1,000, you put it into a retirement account, you buy some crazy tech stock that is exploding in value, and the value continues to go up and up and up. Doesn't matter. Even if within the account they are buying and selling, the tech stocks or whatever, any gains you have, you don't pay taxes on until you take the money out in retirement. Whereas in a brokerage account, if you took that same $1,000 and bought some tech something or another that's going crazy, and then it goes up and then you're buying and selling within the account, you're going to pay tax on all those gains. Now, the tax is at a reduced rate. As long as you're holding the investment for more than a year, we pay tax at the capital gains rate, which is generally lower than the income tax rate. But those are your two benefits to a SEP or a solo 401k or a traditional IRA. Tax deduction for the contribution and then tax deferred gains throughout the life of the investment.
So for me, I'll let you know my personal approach. I have a Roth IRA and have
Amazing.
for years because my thought process is taxes always go up.
Yeah.
So like historically, people paid less taxes 100 years ago, 50 years ago than we do now. So if I'm thinking I'm retiring in 35 years, we'll be paying more taxes later. So I'm like, well, I'd rather just pay them now. Is that like a logical way to approach? Like, is that because I'm sure people are like, you just named 5 different kinds of accounts. And I'm sure some people listening to this, if they haven't clicked off yet, they're like,
Well,
my brain
too
is
many. Hmm.
like, it can, I was going to say that in jest. I just mean like this information
Yeah.
can be overwhelming,
It is
right?
overwhelming. Yeah.
A SEP account, solo 401k, Roth IRA, traditional IRA.
Mhm.
Which one is right for me?
Right.
And you went over a lot of those things, but I think to me, what I'm hearing is that tax piece seems like a big consideration.
I think it is. And I generally agree with you that in general, taxes go up, especially as your income goes up, right? And if I were betting, I would bet in 35 years, we will be paying more in taxes rather than less. I'm not a betting person generally, but that's generally where I would land, right?
Uh-huh.
Here's the only caveat I would make. In general, the first tax bracket is 10% federal income tax up to 11-ish thousand dollars of taxable income. And then for a single individual, you've got about another 35-ish thousand dollars at that 12% federal tax rate, right? So that tells me if you're someone whose income is under taxable income is about under around 45,000 or so, the highest federal tax you're paying right now is 12%.
Sure.
So if I fast forward to you in retirement, Hassiem, I think you're going to need more than $45,000 a year to live on. But if you have a Roth pot that is post-tax, and if you have a traditional pot that is pre-tax, you could take a distribution from your traditional IRA or SEP or solo 401k dollars to give yourself up to, let's call it $44,000 of taxable income so that you're paying tax at 12%. And then you take your Roth dollars out for however much you need above that. So you are intentionally managing your sources of income so that you're hanging out at those lower marginal tax brackets.
Ooh, I like that.
Right? I know.
Yeah.
And it starts to be kind of complicated. So is it worth it? Maybe. There are lots of people who are like, screw that. I just want a Roth or traditional. I don't want to worry about it. And that's okay too, right? Because you can get really deep into the strategy and the weeds of the management of this. But the deeper you get into the strategy and the weeds, the more complicated your life becomes. And if you love complication, go nuts because it really is fun. If you're like, screw it, Elaine, just give me an IRA and I'll be fine, I will say that is totally fine too, right? Because you're still participating in a way that feels good. And in 15 years, maybe you'll be like, oh my gosh, I get it now. It makes sense. And that's okay. Life is long.
So the takeaway is fret not, freelancers and artists. There are many ways that we can contribute to retirement, whether we have an employer that has a way for us to contribute through. We can do it on our own. There's lots of options. And at the end of this episode, Elaine will let us know how we can get in contact with her specifically if you're like, I'm still not quite there, but I'd love some more help.
Yeah, for sure.
Alrighty, here's a new one. This is another one of those areas. I consider myself like pretty financially literate. But this is one of those areas where I'm not like, well, it's new. It is a thing that happened this year. And then there were some changes very recently. And this is on our qualified income for freelancers, qualified business income. So previously, earlier this year, it was that freelancers and gig workers could deduct, or who earn tips, could deduct up to $25,000 in qualified tip income and $12,000 in qualified overtime pay. So say you made $50,000 of earned income this year. Basically what it was saying was that, well, if you're an employee who makes tips, let's say you wait tables between gigs, you could say out of the $50,000 you earned this year, I'm going to deduct $25,000 away from that taxable income, making your tax load crazy. I mean, that's a change in tax bracket.
Yeah.
As we were just discussing.
A substantial one.
A huge one, right?
Yeah.
So my question is, one, could you just clarify for us this law and the changes that have been made? And then two, how this relates to other deductions, like the standard deduction that everybody takes.
Right. Or that qualified business income deduction, right? That QBI.
Right, that 20% of, like if you have qualified business income, you can deduct 20% of that. Like, can I get 20% plus a 25,000 in tips plus my 12,000 standard? Like, I'm like, where?
And the answer is yes, potentially.
Oh.
And there are some things to sort of note here. First of all, we use the word qualified in a couple of different contexts, right? And we have a special definition of qualified for each context, which is super annoying. And I just apologize, right? Because it's tax law, right? It's just very annoying. So let's start with tips, right? So if you have a qualified tip, it has to be a voluntary payment, right? So in your example of waiting tables, most tips are voluntary payments. But let's pretend you wait like a table of 10 and there's that mandatory 18% tip. That is no longer voluntary. So that doesn't count as a qualified tip.
Ooh.
Now, who has been tracking that this year? No one. In 2026, the records will be better, right? But a lot of the guidance for 2025 is, okay, do your best, use a reasonable method of figuring this stuff out. And then 2026, the records are going to be really clean, right? So has to be a voluntary payment. And it has to be for someone that's customarily receives tips, right? So that means I can't say, hey, I'm changing my whole business model. It's no longer fee for service. Everyone is just going to tip me a suggested amount and then it's going to count, right? That doesn't work. The Treasury Department has shared a list of Treasury tipped occupations, right? And each one has a code. You're going to need that code. And we'll share a link to the PDF in the episode notes so people can peruse this. But let's pretend you are a performer and you're going to sort of busk as a performer in the subway, right? And put out, a hat or something, right? That feels like it would fall into probably code 206 for musicians and singers who are sort of busking, or 208 for entertainers and performers, right? Entertainers and performers generally is described to be someone who entertains audience with artistic expression and customarily receives tips. So I don't know a whole lot of like Broadway performers who get tips after the show, right? But street performers, sort of subway busking, that starts to feel more like someone who customarily receives tips.
Sure.
There's another category that's super exciting for digital content creators. So let's pretend there's a link to tip you for this podcast, right? And you are customarily receiving tips. Guess what? That counts as a qualified tip. And I see a whole lot of performers and musicians and actors and dancers and other creative people really being able to lean into that particular category. And that makes me really excited.
For y'all listening at home,
now's a good time to tip.
I've never asked for any, and I will take them all.
Yes,
so,
for sure.
I would never prevent anyone from sending me money. Let's be clear.
Which also sort of, and again, this is super new, right? But it sort of invites the thought experiment of like, how does something like a Substack or a Patreon fall into this, right? Technically, that's a subscription or a membership. Is there a tip opportunity, right? And I'm sure we will get more information and more really good examples in 2026. So for right now, what you need to know is you have to be in an occupation of someone who customarily receives tips, and the tip has to be voluntary. And here's the other thing. And so far, it's been mostly good news. This is less good news. The tip has to be reported as taxable income to you. So in your original example, you said you had $50,000 of income and would you get that $25,000? Yes, if In waiting tables, you got your, $2.37 an hour or whatever, and that made up, say, $25,000 of your income, and then the restaurant reported $25,000 of tip income to you. If that's the case, then then you can get up to $25,000 or the amount of qualified tips as your deduction. But let's pretend $50,000 is basically just your reported income, and you're pocketing tips that are not reported. That doesn't count, right? Because you can't just take up to $25,000 in that deduction. The income has to be reported first, and then you take the deduction against that qualified tip income, right? And here's the other piece of slightly bad news. When it gets reported, you have to pay Social Security and Medicare on it. So it is not totally and completely tax-free. It's just no income tax on tips. You're still paying Social Security and Medicare.
Oh, okay. I have questions. Okay.
You should. Yes.
So
super complicated.
And I'm not somebody, I've never waited tables, but I have a lot of friends who do, and a lot of friends who cater. I've done like other typical gigs, but I know that's a world in which so many of my friends and colleagues work in. Okay, let's be real, because on my show, that's what we do here, right? I'm keeping it real.
What percentage of tip income is reported?
Right. Like, and what is the impetus to report it, right? So for most people, especially, I mean, we're talking about, we're not talking about 6-figure earners here in this example, right? So let's say you're making the average American salary or less, and you have tip income. Why the hell would I report it? I know, Elaine, you would recommend to every single one of your clients they report it because that's the law.
I generally say you should follow the law, and
generally you should maybe follow.
Come on.
Maybe,
So the benefit, though, of reporting it is your Social Security distribution will be larger later when you have paid in those dollars to the system, right? Sometimes we hear this outside of a tipped context for freelancers who might be like paid in cash. They're like, why would I report that income? It's like, well, do you remember the pandemic? And yeah, I get it. Why would you, right? But if you remember the pandemic, the relief was tied to what you reported as your taxable income. So if you were like, hey, I actually made a lot more, I just didn't tell you about it, they're not going to give you a larger relief check, right? That's not how this works.
Right. Or unemployment.
That was a very sort of tangible example of, okay, people who were reporting everything then had their relief sort of more aligned with where they were economically, which was good. And reporting everything means you're paying additional taxes on it, certainly Social Security and Medicare, right? So I get it, right? I also think even if people try to accurately report everything, cash flows sometimes in creative ways. So sometimes our records aren't sort of flawless and phenomenal, right?
Sure.
But I will say in a lot of restaurant establishments or places where tips are common, a lot of employers are, in fact, reporting tips to their employees. Every single one on a W-2, probably not, right? But, because credit cards are the most common form of payment now, especially in restaurants, there's better data, and a lot of the restaurants are reporting that, especially if it's like a tipped pool or something like that, right? Doesn't mean everybody is. But for those folks, okay, great. You're already paying all your taxes. Now you get that deduction. That's great. If you're self-employed and you're getting your own tips, right, you can report them on your Schedule C. And then you're eligible for that deduction on, now it's called Schedule 1A. There's a special deduction for the tips deduction, or special form for the tips deduction, because of course there is, right? So if you're self-employed and you're tracking your tips on, your virtual tip jar, right, you've got the data, you'll report it, you'll get the deduction. That feels fine. Where it feels especially hairy to me is if you're working for a restaurant and they're not reporting tips to you, but you're keeping track of it. There is a way for you to self-report your tips. It's called Form 4137. I think it's a very rarely used form, if I had to guess, for exactly the reasons you outlined. And someone might do the math and just be like, you know what? Yeah, yes, I will have to pay Social Security and Medicare, but it's worth it because I'm going to take my taxable income down to zero or something like that. So those are sort of high-level facts, have to be in an employee who customarily receives tips, has to be reported as taxable income to you, right? And then it has to be a voluntary payment, not a mandatory one. And
Heard.
2026, the records are going to be so much better. There's actually going to be a box on your W-2 that says what your tipped occupation code is and how much qualified tip income you got. Now, it's not going to happen on the W-2 you're getting for 2025, but they've released a draft W-2 for next year, and it's going to give you the information you need if you're an employee.
Okay, so if I'm a waiter and I make a ton of tip income, and currently, like, my boss has been reporting it because we all put it into a pool. This is a huge benefit.
Huge.
Yeah. Like that's like kind of obvious.
Because you're already paying all the taxes. Now you're just not paying income taxes on it.
Right. So that's huge. Your income tax liability has plummeted.
Correct.
If you're someone who's been taking them tips under the table, it is
hypothetically. Yeah.
Hypothetically.
It may or may not help you.
Boom. There we go. Okay, cool. And to clarify, is this stackable on top of the standard deduction?
Yes.
Okay, cool. So again, if you make 20, oh my God, if you make,
I know.
Shoot, wait a minute. I might need to go pick up some tables or something.
Right?
Because if
holiday season, lean in.
Because, okay, so from our example, if you have $50,000 taxable income, 25 of it you can justify, you can prove meets those qualifications.
Qualified tips. Yep.
Qualified tips. You deduct. Now your income is 25,000.
Correct.
And then you take the standard deduction of 12,000.
Yeah. Closer to 15 now if you're a single individual.
You're down to the lowest tax bracket all of a sudden.
$10,000 of taxable income, which means I want you in a Roth if you're throwing some money into your retirement account. Why? Because I want you paying taxes at that 10% level so that you can take it out tax-free in retirement.
Wow, this is great news. You could literally go from that's like a 2 tax bracket
jump. Correct.
Jump down.
Yes.
But you still have the money. That's fire.
Well, and the other thing about this, often in tax law, these tax benefits phase out at higher income levels, which means they get reduced, right? This one, the no income tax on tips, doesn't start phasing out until like $150,000 of taxable income. So you could be working at a very, very high-end restaurant, or maybe your partner does really well and you're hustling and picking up tables between gigs, right? Then you can still get this benefit even if you are far beyond sort of the average income person, right? So this really could be pretty fantastic.
Wow.
As long as people are aware that you still have to pay Social Security and Medicare and they have to be reported tips, right? So those complications aside, I think it really will benefit a lot of folks.
Amazing. And let's say, just to add to this example, let's say I was a freelancer whose business qualified as a tippable business, right? I'm not a waiter though. I'm running my own thing. Right. Maybe I'm a landscaper. We'll use that as an example. People tip their landscapers. That's legit.
House cleaner was one of the examples that
house
came
cleaner,
up, right? Yeah.
Great, right. So I'm a landscaper, house cleaner. Can I also deduct up to 20% of qualified business income on the top of the?
Yes. I know, right? So let's say you're a landscaper. So let's say you're making, $50,000 plus $10,000 in qualified tip income, right? So you're looking at like $60,000 on your Schedule C, right? So $60,000 net business income, you're going to pay Social Security and Medicare on that, 15.3%, right? Big tax, right? But you're going to probably get 20% of your qualified business income deduction. That's Section 199A. So that would be $12,000 of a qualified business income deduction, right? Yeah. Plus, you would get your $10,000 of qualified tip, right? Because that's how much tip you had. Plus, you would get your standard deduction. So all of those are, in fact, stackable. And then it gets one better. Let's say within that $60,000, $10,000 of tip, right? Let's say 5 of it was overtime, right? So let's say, you're paying yourself, so it's probably not a thing. But run with me for the sake of the example, right?
Sure.
When we get overtime, and you have to be eligible for overtime under the Fair Labor Standards Act. So that is not everybody, and it is more restrictive than you might think, right? But let's pretend you're eligible for that and you get time and a half. What we call the overtime piece is the half, right? So if your standard rate is $50 an hour and for overtime you get $75 an hour, right? There's no deduction on the 50 an hour. That's just your time. But the
Right.
overtime, that extra overtime premium, that a half of the time and a half, right? $25, that is then deductible up to $12,500 per return. Right. So, or per person per return. Right. So that's something just to kind of be aware of as well. So all of these are stackable on top of each other.
Wow. This is overall really great news.
I agree.
I know we like to dog on this current administration, but this is really great news for people who exist in this world.
There are definitely going to be some benefits. I have some issues with how it's sold, right? The idea that like no tax on tips. Well, it's no income tax on tips. And I understand we're parsing here. And to your point, if you're already someone who's not reporting all of your tips, this is probably not going to help you, right?
Fair enough.
And if I'm being honest, those are the people who need the most help. Having said that, there's a real benefit to people for these sort of particular deductions. And that is a really, really good thing. Also, that qualified business income deduction, that 20%, that is now permanent. That was originally introduced in the Tax Cuts and Jobs Act, and it was set to expire at the end of 2025. The new legislation in 2025 has made that permanent. Now, permanent in tax law doesn't really mean anything other than it's not going away, certainly in the immediate future. So that's a good thing. But on the flip side, the premium tax credit for purchasing healthcare on the exchange is set to expire on December 31st. So that's basically why you probably hear in the news, like those subsidies for health insurance are going away. Those credits are set to expire on December 31st. On balance, some things are good and some things are worse, right? And again, it's just complicated and it puts more burden on the individuals.
But the more informed we are, the better we'll be equipped to handle it, to navigate it, to pivot, to adjust. So thank you, Elaine, for so much clarification today. I'm so glad I took you up on your offer to come back on. We made it through all of my initial questions.
Hooray!
So check all those off. Those are all the things that were like so top. I was like, there's so much that happened in the last like 6 months. And so thank you so much for clarifying those. Maybe we'll have you back in the future when other things change.
I suspect there will be more tax law changes in the future.
Yeah. Elaine, thank you so much. So we promised the folks that we'd let them know how they can get in touch with you in case they didn't listen to last week's episode. If somebody listened to this episode and they were like, oh my God, I'm like out of my depth, or they're like, well, I thought I was pretty good, but I learned some things. And let's say they want to have a chat with you. How can they go about it?
Best way to do that is to hop on minervafinancialarts.com. You can book a session there, a coaching session one-on-one with me or one of my teammates who are all equally fantastic. And we'll chat about whatever you want to chat about for 45 minutes and then send you a little recap about it. So that's probably where I would start. There's also a contact us form if you want to just drop me a note through there. That's the best way to get me.
Fantastic. And I've done a consultation with Elaine. That's how we got to know each other. She is truly fantastic. Her team is fantastic. Can't recommend them enough. They're not sponsoring this or anything. I just am genuinely, those are my feelings. Yeah. So get educated, guys.
Yeah. The other thing is, if you are a performer who works with major groups, there's a good chance we might work with your major group as well. So if someone wins an award or a fellowship, say through TCG or Young Arts or some of these other sort of programs, oftentimes we work with those programs to provide the consultations to the individuals. So the individuals don't have to pay, the institutions can. And that has been a really, really wonderful business model to get the information to the folks who really need it.
Elaine, thank you so much. Loved super educational conversations these last couple of weeks. Thank you.
You're so welcome. Thank you for all you do and all the best to you and all the creative folks out there who are navigating some complications. I am glad you exist in the world and are doing the work you're doing.
Alrighty, folks, if you enjoyed this conversation with Elaine, then you will absolutely love last week's conversation with Elaine, part 1. So be sure to check that out if you haven't already. Major shout out to our co-producers and distributors over at Next Chapter Podcasts. Thank you all so much for tapping into this episode of The Actor's Instrument. We'll be back next Tuesday. Till next time, y'all. Peace.